John, we've talked before about when you buy a stock, you're generally looking to buy and hold it for 3 years at least, if not longer, barring any change in the fundamentals and so on. But with all this volatility created by the Russia-Ukraine war, what are the challenges presented to you in terms of strategy, and does that affect your strategy? How are you managing through this?
We very much are buy and hold kind of people. But when I see stocks go down and people start to panic, perversely, I kind of become excited. And so you want to start doing things because there's bargains out there. And you know, you make your money when people are afraid, not when they're joyful. And it certainly seems that we're entering one of those periods where things are going to be a little bit more uncertain for a reasonably long period of time. You've got a bunch of things. You have a war going on, you got inflation, you got central banks talking about raising interest rates, you're going to have an election coming up. So there's lots of reason to have a lot of disruption going on. And so it certainly would appear that with this kind of volatility, which doesn't usually last very long, that you want to be able to be reasonably dynamic. So you have a core portfolio that you always sort of really hold on to. We tend to always have some cash kicking around, or we have our fixed income assets, for example. And when things start to go on sale, we start thinking, okay, you know, bank stocks are down 20% from their highs. Has anything really fundamentally changed about our longer term view? So let's buy some Bank of America at $38 a share, for example. It's down from 50. So, you know, our weight might be 4% in the portfolio. We'll go to 6%, draw our cash down. Then if things really rally very back strongly because peace is breaking out, for example, let's say, people become a little bit more optimistic, we might trim that position as things move. Unless we get a 10% rally, we might reduce the position a little bit. Always thinking about what our market's going to be thinking about next. So people start being, you know, you get these relief rallies, maybe you use these opportunities to trim a little bit. And then when you have little setbacks, you have opportunities like at extremes to add more securities. So there's that old saying, buy the dip and sell the rip. You know, there's some people that think that that's what's going to happen. I think that there certainly is some reliable indicators that that's probably not a bad strategy to hold, but you never sell everything, and because you never want to be, you're always in portfolio management, you're always trying to make sure you're hedging your risks, that you're wrong. And so we always have some cash reserves, so when you have these kind of opportunities come along, you're able to take advantage of them.
So you're managing your risk, and you're being incremental in your moves. Now, you said that this year will likely turn out to be more of a trading year than a buy and hold year, and you've been hitting at it there. I know you've put on option strategies even fairly recently. Is that something you're deploying right now or thinking about doing?
We did it when the markets in January were really, really strong. We had a very strong fourth quarter. People were really euphoric. I think some people have been caught flat-footed with too much cash. That made the market squirt even higher going into the end of the year with a lot of FOMO. And the first week of January, things looked like it was pretty optimistic and not a lot of upside left. And there were certainly some, you knew the Fed was going to start raising interest rates. You knew that people were going to start talking about that. So we introduced a strategy by selling calls against our positions in our fund and using the premium that we earned on those call positions to buy downside put protection. And we got lucky. It happened a lot quicker than we had anticipated. We ended up taking all those calls and we monetized the puts. We were able to buy our calls back for almost nothing. We captured all that premium and protected a good chunk of our portfolio from the downside. Would we do it again? We're not that kind of investor. We'll do things on extremes. If markets were to go on to record highs here, we'd have to look at why is that? Has our thinking changed? Has inflation completely collapsed and prosperity rung out aloud? So not right now. It's really more of a fundamental issue of whether we don't think either there's a lot of risk or there's a lot of opportunity by taking these positions. But it's sort of it's not a core competency of ours.
But do you expect to be more active this year than usual, at least through the war, however long it lasts?
Yeah, when war broke out, our clients we had been building up cash positions as the year had gone. Last year had matured. Our clients, we're getting new clients. Our results have been good. So when war broke out, we had 15% cash or more in some client portfolios. We started putting that money to work. So in our fund, when war broke out, we had 15% cash. We're now down to just under 10. And so, the market's now rallying smartly. We'll see where this relief rally takes us. Because I think even if peace breaks out, we still have inflation. We still have rising interest rates. We have an election coming up, and we have a decelerating economy. So we're more likely than not to continue to think that there's going to be turbulent, tough times for an extended period of time.
We've talked before, John, about you having been in the business for a long time, since I guess you said 1985. So you've seen it all, from the 87 crash on through the other crashes, all the geopolitical events and worries over that time. Each time is different. How would you describe what you're navigating through and other investors are navigating through right now, and the particular challenges?
When markets get turbulent, usually it's on the downside. And so you're doing a lot of reading, you're doing a lot of thinking, you're looking at things, you're looking at the dislocations. I think as you get older in the business and more experienced, you think, well, this is nothing compared to 08, 09. I mean, that was really wild. This one has been pretty controlled so far. And I think you look at these risk moments as opportunities more so. And that's really the experience, the benefit of experience and having some great gray hairs. But you're always doubting yourself a little bit. The worst enemy in investing is overconfidence. And I think that, I go to bed every night, thinking about, you've got this crazy man who's really basically upset the whole world. And, you assume that there are safeguards, that there's redundancies in there, that one guy just can't start a nuclear war. You assume those things, but you do always sort of wonder, well, maybe not. But then you go, well, if that's the case, the value of my portfolio today was really immaterial. We don't have to worry about that any longer.
Right. I want to get to that too. Are valuation models, in a sense, just kind of out the window now to a degree? I know it's difficult to answer, but if the war drags on, can you be confident that the economy is going to remain fairly solid and that corporate profits will remain fairly solid? Or again, is most of that kind of out the window and you can't rely on typical valuations?
It's a challenging question. In some respects, the war as it's being waged right now is unsustainable. It's a very different war than what you've normally seen. You have seen the world ultimately really wage economic warfare against a country. And it's very unpopular, I think, within Russia's own borders. And my sense is that Russia cannot wage this war for long. And what's really concerning is that there's no easy way out for this guy. He's made a colossal mistake. And that's what's concerning, because a caged animal is a dangerous animal, or a cornered animal. I think the longer that you see these supply disruptions exist, the more problematic it is, certainly for Europe, and you already have a decelerating economy. So the risks of of recession go up. So the paradox is recessions are the best times to buy stocks. And the market right now is beginning to price in the risks of recession. So you get this relief rally if the war ends, but then you're back to, well, how fast do these sanctions come off? And one last interesting thing that's really, I think, germane to this is, it's not a war that's being waged other than the poor Ukrainians and the poor Russian soldiers, quite frankly, too. It's being waged by businesses who are saying, I answer to shareholders and they will not do business with that country. And so Russia is being shut down. They are being pounded into the Stone Age economically. And Putin can't control, Putin's bodyguards, their mothers and fathers have to get the food up the same shelves that their neighbors do. And that's a real problem for Putin.
What do you make, and you hinted at it there, of all of these corporations, the laundry list of McDonald's and Shell and Unilever and you name it, doing what they're doing? I hate to be cynical, but are they doing it because they're doing the right thing and they think they're doing the right thing? Or are they doing it because, as you said, their shareholders, their customers wouldn't tolerate it if they did any more business? I mean, one outlier is Uniqlo, the Japanese retailer. They're keeping their stores open.
I think it's a function of wanting to do the right thing, and a function of corporations becoming more attuned to environmental, social, and governance considerations and issues, and really beginning to think that they are going to be held accountable. And the politicians oftentimes aren't very effective. And the most effective tools, to use a conservative's phrase, is to let business make business decisions. And so I think it's a war like no other war we've ever seen. It's a war that I think I think businesses finally maybe found that way to reach out to people in very profound ways. And companies like Uniqlo, I think, run the risk of the social media world these days of having their brand severely damaged. How long that lasts? Henry Ford the Ford family were supporters of the German army in some respects and profiteering from it. People don't remember that anymore, but that's a fact. But it's going to be very interesting, I think. But short answer, I think it's a little bit of doing the right thing and a little bit of cynicism. But I think it doesn't really matter. In the end, it's working.